AI is taking the tech world by storm. With its major benefits, it can also be a money-making machine. Cathie Wood is investing heavily in AI, and she believes that this could be the next multi-bagger. Let's take a look at her view and the top stocks she picked. In a recent interview, Cathie Wood stated that AI is going to enable the most massive productivity increase in our history. In a paper they produced, her ARK Invest team estimated that the economic impact of AI-related increases in productivity worldwide might reach close to $200 trillion. Naturally, Wood and ARK Invest are optimistic about a number of AI stocks. Her comments are a follow-up to an artificial intelligence analysis entitled "Investing in Artificial Intelligence: Where Will Equity Values Surface?" That was released by ARK Invest last month. The investment firm's investigation revealed that the once reliable cash cow businesses of renowned online marketplaces could be disrupted by artificial intelligence technologies. According to the business, OpenAI's ChatGPT will eventually be productive enough to pose a challenge to digital behemoths like Apple and Alphabet by undermining two key online services, the App Store and Google Search. Nvidia might be expected to be near the top of the list. Nvidia's graphics processing units are in high demand from AI startups. The chipmaker isn't currently among Wood's top picks for AI companies either. She prefers one emerging AI stock to Nvidia by a wide margin. Over the years, ARK Invest profited greatly from its investments in Nvidia. Wood believes that an emerging AI star is a better option right now. She is also backing up her words with deeds. The fourth largest holding among all ARK Invest exchange-traded funds is UiPath. No other stock with significant ties to AI has a higher weighting in ARK Invest's overall portfolio than Tesla, Wood's perennial favorite. For Wood's ARK Autonomous Technology and Robotics ETF, UiPath is ranked second. For both her flagship ARK Innovation ETF and ARK FinTech Innovation ETF, it ranks as the fifth largest holding. What makes Wood such a fan of UiPath? In terms of robotic process automation, the company is a pioneer. Customers can use its platform to use AI to automate various business operations. These clients include Uber, Fiserv, and Deloitte. UiPath was mentioned in the study by ARK Invest about investing in AI that was published as being a member of its AI's sleeper web. According to the report, ARK has high conviction in the future of UiPath's business. How does UiPath compare against Nvidia then? Negatively in many ways. The share price of UiPath has decreased by more than 70% since its first public offering in April 2021. The revenue growth for Nvidia is far more impressive. The chip maker's sales increased by more than double year over year to $13.5 billion in its most recent quarter. The second quarter sales for UiPath were $287 million, up 19% from the same period last year. UiPath is still not profitable. In quarter two, it reported a net loss of about $60 million. Nvidia's net income, meanwhile, increased 843% year over year to about $6.2 billion. However, this is the one area where UiPath significantly outperforms Nvidia. Compared to Nvidia's price-to-revenue ratio of almost 35x, UiPath's shares are currently trading at less than 8.8 times sales. Wood may not be incorrect to prefer UiPath's stock to Nvidia despite UiPath's generally subpar performance in contrast to Nvidia. It's critical to keep in mind that the two businesses are at quite different points in their lifespans. The $10 billion market cap of UiPath is but a drop in the bucket compared to Nvidia's market cap of more than $1.1 trillion. Should you also prefer UiPath over Nvidia? For many investors, the response ought to be no. Nvidia doesn't run the same risks as UiPath does. Nvidia is undoubtedly not risk-free, especially given its astronomically high price. On the other hand, bold investors seeking early-stage AI opportunities that might be undiscovered gems may wish to give UiPath considerable consideration. The company's RPA platform has a lot of potential. Smaller AI stocks in general offer more upside potential than mega-cap names, according to Wood and ARK Invest. And they might be accurate. Apart from Nvidia and UiPath, Cathie Wood also targets some more AI stocks, and one of them is Salesforce. In terms of customer relationship management software, Salesforce is the industry leader. Its platform enhances communication and productivity amongst marketing, business, sales, and service teams, thereby assisting companies in gaining new clients and retaining existing ones over time. The majority of businesses in most industries may benefit from that value proposition. CRM software and business resource planning software are the two biggest verticals in the larger corporate software as a service market, and Salesforce is without a doubt the market leader in CRM. Salesforce claimed a higher growth in revenue than any rival, and its platform accounted for 23% of CRM sales in 2022, more than the next 4 suppliers combined. A spectacular second quarter report shows that the same strength has continued into the present year. Non-GAAP earnings increased 78% to $2.12 per diluted share, while revenue increased 11% to $8.6 billion. On the results call, CEO Mark Benioff also mentioned that Salesforce is now the 3rd largest enterprise software provider in the world. Investors can be confident that this momentum will continue because Salesforce is focusing on the market for artificial intelligence software and because CRM sales are expected to expand at a 14% annual rate until 2030. It has unveiled a number of new tools that streamline several CRM procedures. In the future, Salesforce should be able to raise revenue at a rate of around 14% per year, while it may expand more quickly if its AI products become huge successes. In any case, its present value of 6.6 times sales seems reasonable given the likelihood of revenue growth in the mid-teens. Investors need to feel at ease taking a modest investment in this growing stock right now. Another stock Cathie has in her portfolio is The Trade Desk. An advertising technology platform run by The Trade Desk assists clients in developing, evaluating, and optimizing data-driven campaigns across digital platforms. Its software uses what the company's management refers to as industry-leading AI to uncover insights and adjust targeting parameters to increase clicks and conversions for marketers. In a report released earlier this year, Quadrant Knowledge Solutions to some extent supported that claim. The Trade Desk was named the top ad tech platform by the consultancy due to its unrivaled technological prowess and more client impact than any other suppliers. The latter point makes a reference to a crucial distinction. The biggest independent ad tech company is Trade Desk. It doesn't own any online properties, thus it has no motivation to favor any certain inventory. Contrarily, Alphabet has a strong incentive to send ad purchasers to its websites since it controls Google Search, YouTube, and numerous other web domains. It's true that Alphabet has significantly benefited from using that approach, but flaws are starting to show and the Trade Desk is gaining market share. In the second quarter, those share increases persisted. Revenue increased by 23% to $464 million, substantially above Alphabet's stated 3% ad revenue growth. In addition, the Trade Desk reported a $33 million GAAP net profit, up from a loss of $33 million the year before. Ad tech sales are anticipated to grow up to 14% yearly rate through 2030. However, given its technological superiority and independent business strategy, which are obviously appealing to media buyers, the Trade Desk should be able to expand considerably more quickly. Given that the 3-year average valuation is 29.9 times revenue, the current price of 24.8 times sales seems appropriate. Investors should start off small in this growing stock today and add shares judiciously when the price declines. The last bullish stock Wood prefers is Teladoc. A further $301.07 million worth of Teladoc Health is owned by Wood's flagship fund. Through video, phone, and chat, the company's platform connects patients with medical specialists. The need for telehealth services surged at the height of the COVID-19 epidemic, when non-emergency in-person medical care was temporarily stopped. Teladoc received a lot of investor attention in 2020 as a result of a 98% increase in revenue. Despite the fact that the pandemic is largely behind us, the company is still growing. Revenue for Teladoc increased 11% from the same period last year. However, the stock was unable to keep up its upward momentum. With a share price of $24.30, Teladoc has dropped more than 90% from its record high in February 2021. Wood recently wrote on X that the fusion of AI and digital assets might radically change how businesses run, leading to a significant decline in operating expenses and an explosion in productivity. The ARK Invest CEO continued by expressing her amazement at the fresh opportunities that today's entrepreneurs are generating. What's your view on AI, and will they become the next Tesla? Let us know your views in the comments section below. To get more updates and videos on the related content, you know what to do. Like, share, and subscribe, and hit the bell notification to get the latest video updates. See you soon.